Well, here's a tweet from a viewer at B2Invest, and the question is, what's your outlook on Apple? Do you think it will continue with share buybacks and dividend increases in 2016?
Okay. So Apple's obviously an important stock to a lot of people. And this was one of the clues that led us to believe we could wind up in some kind of a correction as it started to underperform the market over the last few months. And in December and November took out some fairly important levels technically. So at this point, here's what I think you should be doing in a market like this. You want to be trying to identify companies that for whatever reason have prices that are holding up much better than the market, where they have fundamental characteristics that point to something changing for the better and prices behaving like they should be given what you think you know. And really what you want to do is build an inventory of companies you'd like to invest in if the market can find its footing. And you don't have to pick bottoms. So to own a stock, to buy a stock that everybody owns to begin with, at a time when the stock is underperforming its peer group, now the market, is probably not the right thing to do. I think it's a great company. I think they get great products. I've got a lot of them. But this is probably not the time to be buying that stock.
Just no momentum in it?
There's negative price momentum, so weak stock, weak sector. I would avoid the stock for now. There's lots of people who own it at higher prices. So as the stock rallies, it's going to run into people who are just waiting for their opportunity to exit at their price. They're going to have a tough act to follow after the iPhone 6 and after all the products they've announced over the last couple of years. So I think I would just give it some space and look for something that is behaving much better than the market, that does have numbers that are accelerating, not decelerating.
So it's a decent stock, just the price action and
good company, not a good stock right now.
Exactly. Okay. Let's head to Windsor, Ontario. Brian, go ahead.
Good afternoon, gentlemen. David, if you held a Progressive Waste stock, now that they're merging, would you keep it or hang on to it? Thank you.
Well, so Brian, here's the way I would look at that. If you look at some of the peers within the waste management space, the stocks are behaving quite well. So if you were to look at something like Republic Waste or Waste Management, these are behaving much better than the market. So the space is doing well. Generally, when you get a merger like this, there's opportunity for some cost savings and some synergies. So this is a sector that I would consider, and it's one that I'd take a look at. If you own the stock, I'd probably let it play out a little bit here and see what they're able to do by putting the two companies together.
Okay. Mohammed is in Delta, BC. Go ahead, Mohammed.
Thanks for taking my call, and good morning from West Coast.
Thank you.
My question is on CNR for long-term hold, for growth and dividend. What do you think about this stock, and why is it fallen today since the market is on a positive side? Thank you, and have a good day.
Thanks.
So if we were to look at, as we talked about earlier, China being sort of the epicenter of the problems in the current market, one of the things, obviously, that falling demand in Asia has led to is weak commodity prices and weak demand for commodities. And so the rails in general have been difficult. Now, CP is more commodity-related than CNR, which is more north-south. But transports as a whole are behaving very poorly. So I'm not one for trying to pick a bottom. If a company's behaving weak relative to the group and the group is behaving weak relative to the market, I'd prefer just to wait that out and see something turn for the better.
You're not looking for that magic moment when the stock bottoms and you get to buy it.
I want to buy them going the other way. So listen, I think CNR is a great company. I think it's really well run. I think that it's well managed. The issue is it's a tough industry right now. So a good house in a bad neighborhood is not my cup of tea.
They say buying a good house in a bad neighborhood is a bad idea generally.
Yeah.
Right, let's head to Bill in Montreal. Go ahead, Bill.
Hi, what does your guest think of Jean Coutu as a long-term hold? Is it a good defensive play? Thank you.
Great. So if I were going to look at retail right now, I'd probably be looking at off-price retail or convenience. Couche-Tard is one that I would take a look at. Coutu's, down about $10-11 from the highs. It's underperforming the group. So I'd prefer to look at a Couche-Tard or a Dollar Tree in the U.S. or a Ross Stores, ROST. They all, I think, look a whole lot better. And we do like the consumer, but I want to own one that's got a little bit of a tailwind.
Yeah, you just want something with just a bit of energy right now. Yeah.
Look, a market correction tests the mettle of every company. Mm-hmm. The weak ones sell off at the beginning.
Sure.
And as the sell-off picks up steam, it impacts more and more companies. Until late in the decline, you're getting the strongest stocks. So if within a sector, your investment is one of the companies that getting hit first, mm-hmm. it's because the holders aren't as strong as the ones who have real conviction.
Not as loyal, kind of thing.
And so this is a great opportunity to see what is it that holds up against the selling. And so I would prefer it looking at names that have been able to hold up in price versus a tough market rather than the other.
That's an interesting thesis. Yeah, we should go back to that, actually. Yeah, the ones that have shareholders who are saying, no, I'm not selling
They're
this.
so convinced, despite all the bad news and fear and turmoil, they say, I'm not a seller.
Yeah, well,
that's what you want. That's what you find in a tough market.
Strong hands, they call
exactly
it.
Right.
Yeah, that's right. Okay, well, stay tuned. Past picks are coming up next.